Hello and welcome to CMC Markets Trading Outlook for the week of August the 10th, 2015. My name is Colin, Chief Market Strategist. This week we're going to look at a few different things, but overall the main thing I wanted to talk about this week is seasonality in the stock market. There's not a lot of data out this week, but we are starting to see some of the usual historical seasonal trends in stocks kick in the last few days, and I think that could have a big influence on trading this week. I'm also going to take a little bit of a look at some of the moves in currency markets following U.S. non-farm payrolls, and also take a look at Netflix versus media sectors and some interesting action we're seeing in the silver market as today's been progressing here on August the 7th. So first off, U.S. non-farm payrolls came out 215,000, a little bit below street, but essentially right in the middle of what I call the 200 to 250,000 sweet spot. Above 250, people would be saying lock on for sure for September interest rate liftoff. If it was below 200, people would probably think that, okay, well, the Fed's September might be off the table and perhaps a delay. So right now it keeps the Fed on track, and it's still open book as to whether the Fed will actually raise rates in September or just hint that they're looking at raising rates before the end of the year. As such, today we are seeing a bit of sideways action in the markets, but we're actually seeing lower stocks. We've got US dollar up, stocks down. So I want to talk first a little bit about some of the stocks here. We've got the US 30 really starting to break down here. It's been drifting lower within this broad trading range. So we've got a broad trading range of about 17,125 to about 18,350. That's been in place since December. So we're into the ninth month of this. I said previously that the mid-cycle correction, as I called it, when the economy is improving, but the central banks are starting to look at raising interest rates, usually lasts about 9 months to a year. So we're working our way through the middle innings and probably into the later innings of this. However, could still be an impact throughout August, September, October. Why? Historically, seasonally, August through the middle of October, worst time of the year seasonally for stocks historically. And we get a number of reasons for this. We've got, it actually starts back in May. There's the old adage of sell in May and go away. But what happens is you often will get weakness in May and June, a bounce in July for earnings season, and then after earnings season wraps up, you get this big correction that runs from about late July, early August, through to the middle of October. The only reason why October doesn't often show up as the worst month of the year for stocks is because markets have tended to bottom out mid-October, and often by the end of October are already starting to go into a seasonal rebound. So that's why August and September, historically, two worst of the months of the year for stocks, and now we're getting into them. So we've been in the sideways range. We've been climbing. We've been spending most of the last while in the upper half of this range. Now we're starting to break down and come back towards the low end again. Will this 17,125 be able to hold? It's hard to say. But something else interestingly, I'm just noticing here on the Dow, we're getting a death cross here. We've got the 50-day moving average crossing below the 200-day moving average. That's historically a bearish signal. We also have here on the RSI, it's heading lower as well. So we could see a retest certainly of this 17,125 and possibility towards a retest of 17,000 as we move through the next while. Seasonally. And it's not just the Dow. We're seeing this in a number of U.S. stocks. I'm going to highlight the S&P 500 next, where we can see this also has been stuck in a trading range here between about 2040 and about 2135, dropping down. Once again, we've got it penetrating down below the 50-day moving, the 200-day moving average here, and no death cross yet, but we are seeing the 50 trending lower towards the 200. So a cross is possible, perhaps maybe toward the end of the month. We're seeing RSI roll down as well, suggesting increasing downward pressure. So we're testing here 2070, next support in and around 2060, this Fibonacci level, and these lows here come in around closer to 2040. And if you did get a serious correction, can't rule out the retest of the 2000 round number for the S&P 500. So again, we're seeing some weakness here. And if we look at the NASDAQ, we're also seeing it roll over here. And there it is. Sorry, I'm just going to blow this up here. And also NASDAQ had spiked up to a new high. It looks like that had gotten overextended and it's weakening back. The original resistance level here around 45.55 has been breached, and it's continued to drive lower here. We're seeing the RSI 50 has been breached, and downward momentum is starting to increase. So momentum's rolling over. We've got a first breakdown, and it's continued through that. So we're getting follow through. First support here around 44.85. Then this Fibonacci level down here is more like 43.55. This series of highs here around 44.35. So Nasdaq also looking vulnerable, and it's well above its 200-day moving average, which is down here in and around 43.70. So Nasdaq still vulnerable in the near term and rolling over as well. Just one thing I wanted to quickly show on the S&P. While we're at it, is that we saw in the Nasdaq we were about 50-50 between long and short. We are seeing a stronger short position in the S&P. If we move to the small cap, the Russell 2000, you can see short position here even stronger, getting up towards 80%. As this also is showing signs of rolling over. And this is the broader market here. Look at this. We had a run up to new highs. It's rolling down. You could almost make a case here for a head and shoulders top possibly forming, and we've broken this here, and we are starting to work our way lower. That's 12.15. That's 12.45, 11.85 here, and this one's about 11.60. Again, we're also seeing negative signals out of the RSI showing downward momentum building. In that environment, we're also seeing significant action in stocks, and one of the sectors that's been most intriguing in the U.S. market lately has been the media sector, media and broadcasting. And so I wanted to start here with a look at Disney. Disney is the Dow stock, the biggest company in this, and it's in the Dow. And so what we've got here, I'll take that out because I'm going to show that in a little bit here. This great run for Disney this year, and then kaboom. Huge breakaway gap downward, blasted through the 50-day moving average, almost testing the 200-day moving average around 103.75. Overbought straight to oversold. Heavy selling pressure. Stabilizing a bit here. Maybe we see a hold around that's 105.75 first. But actually, let me just extend this line up here. That's better. So, blasted down through, blasted straight through 23% retracement level. 38% retracement level was breached in the bear trap and then held. That's 105.85. The 200-day moving average 103.45. It may start to find some support back in this congestion zone here. We'll see. But in addition to Disney, I wanted to highlight here how the overall sector's been acting. And what intrigues me about this was Disney had been steadily improving throughout the year when kaboom. So, similarly, we've seen CBS, interestingly enough, the broadcaster had peaked back here in early June, had already been trending lower. Viacom had peaked back in back in December when it's been going the other way. When Disney's been going up, Viacom's been going down. Took another big hit this week as well on earnings. And the other side of this, though, is look at Netflix. Had finished a double bottom back in January, and it's been rallying through the year. Now, it had been in a rising channel. It's actually gotten overextended and blasted up past that, maybe getting a little bit ahead of itself here. And I will show a Netflix chart in a minute, because it looks to me like it's getting up to a pretty extreme valuation. And yes, there's a lot of hopes and dreams built into Netflix, but it seems to me it's getting pretty overextended here. And Netflix in particular seems to be in quite a dangerous position, even though right now it's looking like it can do no wrong, and that it's gone through the roof, and momentum's been strong, and that's what makes me nervous. So I'll just close this chart out now, and I wanted to show Netflix here because it looks like it might be starting to break down a little bit. So let's start with this larger chart here. See, very strong step pattern. Breakout, higher level consolidation, breakout, two gaps here, like wow, consolidation at a higher level, another gap there, another gap there, another gap here. It's like gapping higher and then consolidating at higher levels, and only partially filling in these gaps. Very strong accumulation, but negative RSI divergence slowly building here, extremely overbought through the course of this year. Look at this, gapped up again. Ran into resistance here, 129.25. Couldn't get through it. A second day here. There's a doji back into balance here. There's this run up here. It couldn't really hold it. Closed below its open. in balance. So we're seeing a shift here from the very strong dominance of the bulls and into perhaps the bears gaining the upper hand. Here we've got the high of the day, and it's just generally been dropping ever since. So that's telling me that that perhaps the bears are starting to mount a counterattack here on Netflix. And with it having moved so much, it might not take much to tip it over and get people to start heading back the other way. And in particular, also look here, that's 121.10. That starts to break there. You can see a retest of this line here. Perhaps that's 113.30, give or take. And look, this is a channel resistance line becoming initial support. So that just shows you how far it's blown above its trend and what it could potentially come back to. So we're keeping an eye on Netflix here. We're also seeing, interestingly enough, a bit of reversal in some of the precious metals today, particularly silver. I'm just going to show the gold chart for a minute to start. And we see here on gold that clients are mixed in terms of number of clients. It's been bullish, but in terms of the position value, it's still bearish, and in fact, clients have been going short against gold today. So we are seeing some mixed sentiment. But what we've got for me in terms of gold is it's been in the downtrend for much of the year. We had this big sell-off where it plunged $50 an ounce in a few minutes. It's basically been consolidating and digesting that. Even today, where it's had a bit of a pop from the low 1080s to retest 1100, still cannot get back above 1100. Strong resistance there. I know we're seeing a bit of an upswing here in the RSI, but it still remains to be seen. We got to see it really clear this 1105 to signify a meaningful upturn. Otherwise, this still looks like it's basically a symmetrical triangle digesting. I'll actually draw in this symmetrical triangle of lower highs and higher lows. Historically, a symmetrical triangle is considered to be a consolidation pattern. And what that means is that it's usually resolved to the same direction it was traveling in when it started. So had a big sell-off, symmetrical triangle as a neutral consolidation pattern suggests at some point you could see a breakdown. If you do, I still think gold could be drawn towards the $1,000 an ounce level eventually for a retest. But that being said, silver is looking a little more intriguing today. It's actually popped a little bit, and we'll bring it up here. There we go. So silver looks like it's trying to build a base. This could be a potential double bottom. That's a nice little hammer there. And RSI has been climbing up towards 50, telling me that downward momentum's starting to slow. But it's facing a pretty big resistance hurdle here, about 1505 to 1510, where we're punching up, and it cannot, even with a big rally here, it's taken out its previous highs. It's broken out of a downtrend, but it can't clear this $15 round number. It really, really needs to clear that. I'm just going to draw this in properly here. That's more like it. So we're seeing silver trying to break out of a downtrend. That's encouraging, but it's really got to clear this 15 to signal a serious upturn. But if it does, then gold potentially could start to advance too, and maybe it stays above 1,000 for a while yet. The other thing I'll shift gears quick for a moment here. I'm just going to talk about a little bit about the U.S. dollar and how it's been acting following non-farm payrolls. It had a bit of a pop, and then it's kind of just dropped back a little bit here in the ensuing couple of hours. So, but let's look at action in some of the majors here. We'll start with cable, where we see here it has been range bound between about 152.15. This high here is about 153.20. There's 155.80, this Fibonacci level, and resistance here, 157, and then 158.90. And so what we saw here was weakness in cable since working back. So the U.S. dollar had rallied on the non-farm payroll news because it kept them on. It does keep the door open to a September rate hike, but we're seeing the U.S. dollar give that back a little bit as the day goes on. If we also look at euro dollar here, where we're also seeing the same kind of thing. It had dropped back and has been recovering. It's still bouncing around in a trading range here between about 108.60 and 109.90. And last one I want to take a show here quickly is US dollar CAD. So Canadian employment came out. It was a little bit better than expected. We had a bit of a retrenchment. Last month we had huge full-time gains, big part-time losses. This month we had a drop in full-time and a big gain in part-time. So over the 2 months though, we're flat on jobs in Canada. We are, and the IVPMI purchasing managers came in. It was a little bit better than expected. So for dollar CAD, 132 resistance, still holding here. Overbought RSI starting to roll down. Bit of a negative divergence here. So 132 looking like it's becoming new resistance here. Look at this hanging man, a doji. It's overall looking as though this uptrend is starting to run out of gas. Could be see a correction. First support here is that's 130.45. This one here is where it's sitting now, about 131 even. 130. These there is 129.11, and this low here is about 128.50. So there is room for a bit of a pullback in dollar CAD. And if I bring up that there, then look, this 23% retracement level doesn't kick in until 125.95. So there is room for a fairly significant correction in the Canadian dollar. The last thing I wanted to highlight here briefly is China data. That's we're not seeing much in the way of scheduled economic news this week. The one thing we do get is China data, trade and inflation kick off over the weekend. By the time the markets open on the 10th, those will be out, and then we have industrial production and retail sales a little later in the week. So that's the big thing we're keeping an eye on here. I'll highlight some of the Chinese indices. Hong Kong China H here is still trying to stabilize in and around this 11,000 level after its massive rally and sell off again. However, because this 62% retracement has been breached, I can't rule out an eventual round trip back closer to 10,000. But for now, it does appear to be getting some support above 11,000. First resistance 11,315 and then 11,535. Let's look at the Hang Seng. Hang Seng also huge rally and pretty much had completed a round trip back to its December lows. It's bounced up off of that. So what are we seeing here? Support above 24,160, but we've also still got this downtrend here of lower highs, and that concerns me because we are seeing a descending triangle form. And at the same time, it still suggests continued distribution here. You've really got to get up through 24,700 to signal any kind of a meaningful upturn, and really 25,000, this Fibonacci and round number here, to suggest that we're getting any kind of a real recovery. But for now, downward pressure is easing, and it does appear to at least be going sideways, perhaps into an emerging 24,160 to 25,700 trading channel. I know that's a really wide range, and what it does say to you is that there is some significant room for swing trading potentially in the coming months. So even though it's a little quieter for news flow, earnings season is winding down, corporate economic news is quiet for this week, but there's still the potential for some fairly significant action trading in stocks as seasonal factors work their way through the markets.